Hello and welcome to a brand new episode of Smart Money. On Smart Money this week, we speak about how you can plan and protect your family's needs, your family's expenses through the insurance route. Now, what is the right insurance policy for you? Do you need insurance over and above the corporate insurance that you are provided with? And what are the different options that you can look at through the course of your investment journey? We have Nasser Salim of FlexiCapital on the show, and joining us here in the studio also is Nehal Mota of Finnovate. Nehal has over 15 years of experience in the industry. She's worked with ICICI Securities and IIFL in the past, so she joins us here on the show. And Nasser, of course, has been with us on the show many times in the past. He's a financial planner. He's an expert in the market. So, lady and gentlemen, thank you so much for joining us. Nasser, I want to start with you. The reason why this is more important is because post-COVID, people have, begun to sit up and take notice, evaluate their insurance schemes and plans. So let's just put it out there before we talk in further detail about what are the different insurance plans that are available in the market currently.
Good afternoon, Sonia, and thank you very much for having me back on your show. Very interesting topic and great question. I think, post-COVID, what has happened is people have kind of well-weathered this entire anxiety bang that they've had. So, for 3 years, practically, we were wondering what will happen. And therefore, a lot of questions and, clients tried showing interest and trying to understand what are the essential plans that one needs cover. And broadly, Sonia, I'll tell you, I think the insurance here that we're going to discuss today is purely mitigating those risks that can happen unwarranted, undesired, all of a sudden as an accident. And therefore, the most important ones to cover broadly are the ones such as pure term plans, which we will talk about the advantages of pure term plans. Then there is something called endowment plans, which are a mix of both pure term and savings, which will give you protection and savings. Then there is, we will talk specifically about employer-employee plan. Then there is unit-linked insurance plans. We will talk about traditional plans, and then there are, a mix of all of these coupled with what we call as endowment plus plans. So broadly, these are those plans that we will talk about.
Okay, so we'll get talking about them one by one. Nehal, I believe that a term plan is one of the most important things that you need to have in your financial journey. But I understand that a lot of people still don't have it despite having, dependents like a husband, children, wife, parents, etc. Tell us, what are the key features and advantages of having a term plan?
Thank you, Sonia, for inviting me on the show. And like you rightly said, the mortality protection in India, for every 100 rupees of risk which an Indian family takes, on an average, they have 9 rupees only as cover. So the gap is 91%, okay? That's the kind of less mortality protection which we have. Having said that, like Nasser said, the pure vanilla term insurance is something which all need to have. And typically, if you are age 30, then you have, say, 30 years more of your working life left. So 20 to 30 times of your annual income is the kind of term policy which you should have. If you're in 40s, then maybe 15 to 20 times of your annual income as a term cover. Okay, so I'll say that the term cover is needed for replacing income. If something were to happen to me, I have a dependent son, I have dependent parents, okay? My income, which I generate and give to the family for the next 20 years, needs to be replaced by the insurance policy. And that is why a pure term insurance is a must for every family.
Okay.
And every, earning member of the family.
Earning member, okay. I got that. I have two questions here, follow up. One is, if you have adequate assets in the form of financial assets, right? If you have SIPs and you have a certain amount of corpus that you have perhaps left behind for your children, your husband, etc., do you still need a term plan? And B, what is the right age to take up a term plan? Okay,
so Sonia, you have built assets. But like I said, there are two components to a term policy. One is that at the age of 40, I have some assets, which is already the wealth which I have created for my family. But for the next 20 years, I'm still earning and I will still add to that wealth. Okay, so I need to replace that income which I will generate for my family, which will add to their wealth through a pure term insurance. So that is one way, which is income replacement. The other way, like you rightly said, is that I look at, what is the income which I need to, replace. I, actually subtract the assets which I've already created, I add the liabilities, and then I get a logical amount of cover which I want. So to each one, its own. A lot of clients come that we really want to ring fence or protect the income which we will generate. So it could be a pure income replacement. It could be income replacement, adding the liability, subtracting your assets, and the right age. The early you take the term policy, the better it is, because when you're young, the premium is very less, and you're locked in that premium for a very long term.
Okay. Nasser, I have a couple of questions here. First, of course, the advantages of having a pure term plan, and also what are the do's and don'ts, right? While picking a term plan, how do you select which is the brand that you pick? What are the red flags that you need to sort of look at before selecting a good term plan?
Sure. That's again a great question. So, one of the first few things we need to look at is just not go by the brand by itself, Sonia. I think when you're looking at a term plan, there's something called a claim settlement ratio, which is popular in CSR. And I think a score of over 95% for consecutive years is generally a good trend and a reliable trend to kind of follow. Now, where do we get this claim settlement ratio, and what is it basically? A claim settlement ratio, Sonia, is nothing but the percentage of claims that the company has settled in a financial year compared to the number of claims placed with them. And you can get this from the Insurance Regulatory Development Authority, IRDA website, which basically has under its CSR claim settlement ratio corner, where you can get for each of these insurance providers. Number one. I think the other very, very important point is you can get this feedback from a lot of online platforms to say, what is the level of service? You see, when you are hit by an exigency, what is the kind of level of service and the turnaround time to kind of ensure that the settlements are made reasonable within timelines. So I think that's also very, very important. Two very important parameters is this. And I think one, of course, not the last, is when you're looking at a term plan, you can look at some of the larger private sector players. And when I say that, it will obviously be a function of, again, a high claim settlement ratio. Okay. So these three things, I think one needs to kind of look at.
Have a higher claim settlement ratio and pick some of the larger, you don't have to go for a brand necessarily, but the larger players in this business. Anything else?
Yeah, I'll add to this that what Nasser rightly said, that in terms of the percentage of claims settled versus, the claims they got, you should always also keep on the eye on the value of claims settled. Okay. Because it can happen that you are settling a lot of smaller claims. Yeah. So you are actually getting a higher percentage, but you are actually avoiding high value claims. Okay. So together with the percentage of claim, it's also good at looking at the value of, the claims which are settled in that financial year. And like he rightly said, it's easily available on the IRDA website.
So the claim settlement ratio generally has to be over 95%. That's the best. That's 95. The best.
And most of the top private life insurance companies, private, public, both, are at 95, 97, 98.
Okay, so look at the amount of claims they settle, the claim settlement ratio, and the value of claims that they're settling, right? Yes. The higher claims that they settle in terms of value, it's better for you. All right, let's move on to the Married Women Property Act. Now, this is a subject, of course, that you have spoken about in great detail in the past. So who is it for, and what are the key features according to you, Nehal?
So, PPF is one instrument which is a deemed trust. By the virtue of making an investment in PPF, it's a deemed trust. Second deemed trust which India has is the Married Women's Property Act. So in this, a married man, if he takes a policy on his name and he makes his wife as a trustee and wife and children as trustee and beneficiaries, the entire, the insurance, a life insurance policy, all the maturity proceeds from the policy are ring-fenced under a deemed trust, and they can only go to the beneficiaries in the trust. He could choose his wife as a beneficiary, wife or children as a beneficiary in whatever ratio. Once this deemed trust is formed, it's irrevocable. So even if the married man in future wants to change the trust, he cannot change the trust. So it's a very good tool for you to, put in certain amount of your wealth in a deemed trust, just like PPF.
Okay. Nasser, you want to comment on that, the benefits, and who is it for?
Right. No, actually, clearly what Nehal said is absolutely right. I think, it's a legal provision, Sonia, that grants certain rights and protections to married women, basically regarding their property and assets. And I think one of the very key factors where it can be used effectively is basically, if you wish to ensure asset protection. You see, the Act provides protection to married women's assets from claims of their husbands, creditors. I think this is a very, very important line. So if you have if you have a husband if you have a business which is a smaller MSME, or you put high leverage on your balance sheet, you've got a huge amount of debt, I think this is an act which will help you ensure that your property owned by a woman cannot be seized or sold to satisfy her husband's debt or liability. I think that's one of the foremost important conditions under which an MWP Act can be used, Sonia. The other very, very clearly is, it gives you great inheritance rights. I mean, the MWPA safeguards the women's rights to inherit property and ensures that women can inherit assets from their parents as well, relatives or other sources, without the risk of losing them upon marriage. So I think that's, again, something which is very, very important. I'm sure the male members will not be very happy to hear this in your show, but it is a very important asset and a tool. And the other very quick one that Nehal did point out very clearly is on trust creation. It enables a married woman to create trusts and thereby protecting their assets. So broadly, it's basically a ring fencing tool available to married women, and you can do it through various insurance plans that are available, which can be sought from the market.
Okay, I have many more questions for you on the Married Women's Protection Act. So we'll do one thing. We'll slip into a quick break. We'll come back with lots more on the right insurance that you need to pick, the quantum of insurance, and of course, what all there is out there in the market. More on that coming up in a bit.